All local governments that submit an annual financial report receive a basic review. Now, an annual financial report is what you submit if you are not receiving an audit. That is determined based on the audit revenue threshold. And that has been set in Century Code and was just changed this last session, 2023, to be $2 million. Prior to that, in 21, it was at $750,000, and before that, it was $300,000. So if you were above that threshold, you received an audit report. If you were below that threshold for total revenues, you submit an annual financial report to our office. And again, all annual financial reports receive a basic review. So the basic review is made up of 4 primary items. The first thing we do is we look at the bank balance compared to the book balance. Those must equal. These are cash basis statements, and that is why the book balance should equal the bank balance, taking into consideration if there are any bank reconciling items. The next item we look at is that the funds are used correctly. Now, all local governments have a general fund. That's kind of the fund that all activity can be run through. However, there are other funds for particular types of accounting transactions for which they should be used instead. Examples of this would be the Special Revenue Fund. For anything that is monies that are designated, set aside for a particular purpose, those should be run through a Special Revenue Fund. For capital projects, if you are acquiring something, the long-term capital project means over a year. If you are acquiring or constructing something of that nature, that should be run through a capital project fund. A debt service fund is to be used if, for example, you have any long-term debt that needs to be paid back that takes more than a year to pay. You would run that activity through the debt service fund. And finally, there are the enterprise funds. Those are the funds that are used for the services that you provide for which you are charging a fee to recover some of the cost of providing that service. And those run through that enterprise fund. So we look to see, are you using those funds correctly? The next thing that we look at is to make sure that there are no negative fund balances, unless you have a specific plan to get that balance back above zero. That could be either you know that there are future revenues coming into that fund, or perhaps you are planning to do a transfer from one of the other funds. Now, there are some funds that can have a negative balance. For example, the enterprise fund. If you do a large capital project within the enterprise fund, then you may temporarily run that fund balance below zero, knowing that there are future revenues that will bring that back up, and that's fine. Same thing can happen with the capital project fund when the revenue coming in to pay for the cost of the acquisition or the construction of that capital project, the timing of that might not line up with when the expenses are incurred. So that too could run the fund temporarily negative. Same with the debt service fund for paying off those debts. So the next thing we look at then are those transfers. And the transfers should be proper. Now, the transfers from the general fund, you can transfer any amount of money from the general fund to any other fund. But some of the other funds have restrictions on transfers that can be done. Your special revenue fund, your capital projects funds, and your debt service funds, those all have particular reasons for why the money is there. So really, you shouldn't be doing any transfers from those funds unless the fund has served its purpose and you're actually closing out the fund. Then that transfer would be made back to the general fund. The enterprise fund, you can do transfers out of the enterprise fund of that excess revenue you receive. However, North Dakota Century Code does restrict the amount of money that you can transfer out of any particular enterprise fund to 20% of that year's annual revenue amount. So those are the 4 areas that we look at for doing the basic review, the primary review. And again, all annual reports that are submitted to the office receive a basic review. Now, in addition to the basic review, there's an extended review. You can think of an extended review as kind of like a mini audit. And basically, we look at different areas more in depth. For example, revenues. We'll look at your revenues to see, were they properly deposited and did they go into the correct fund? Expenditures we'll look at to see, do they have the proper supporting documentation to back up those expenditures? Were they approved? And are they allowable costs that the entity should be making those expenditures for? We also look at construction projects. Were bidding requirements followed in doing those construction projects? We may look at payroll. Were the 941s filed timely with the IRS? We may also look at transfers and how they're done. Same with the funds and structure. For both cities and park districts, we'll look at the budget as well, because there are specific guidelines in Century Code that dictate how those budgets are supposed to be prepared. So that's what goes into an extended review. And that then leads to the question, well, what triggers an extended review versus the basic review? Well, there are both automatic triggers and there are triggers that can come up from the basic review itself. So let's look first at the automatic triggers. There are 3 of those that we have. One is the revenue threshold. I mentioned earlier that the threshold has changed over the last several years. So if at any point in the past you used to be required to get an audit, but now you no longer are, that is an automatic trigger for an extended review, because we still want to provide the citizens of that local government area the accountability and transparency that comes from an audit without actually having to do the audit. And the extended review provides that. The next automatic trigger are the one-time revenue sources. This may be the scenario where for one particular year you exceeded that threshold, which would then trigger that you would have to get an audit. Now under 2180, which passed this last session in 23, that's no longer a requirement. We can instead do an extended review. And that one-time revenue may have happened because you took out a loan, or maybe you took out a bond, or you received substantial donations. Whatever it was that caused you to exceed that threshold for that 1 or 2 years, we can now go back and do an extended review for that. The last thing that becomes an automatic trigger are severe delinquency. If you are many years delinquent in submitting your annual financial reports, that also can trigger an extended review. Now, during the basic review process, there are also some other triggers that can come up. For example, if there's unreported data, perhaps we find that there were bank accounts or funds that weren't even submitted to us. If we discover that, that can trigger an extended review. Likewise, if we see that the fund types are being used correctly. Again, earlier I described how those different funds are there for various reasons. If we find that they're not being used correctly, or if they're not even really being used at all and everything's just being run through the general fund, that also may trigger an extended review. Suspicious looking expenditures, or expenditures that are too many classified as miscellaneous, where we can't tell what they are. Maybe we see excessive transfers, or the transfers aren't proper, or they're not correct, or they're used incorrectly. And then finally, if in doing the basic review, again, remember that the basic review, the bottom principle there is that the fund balance, the bank balance, has to equal what's on the books or on the report that you submit. If it takes a material adjustment to get those numbers to match, that will also trigger an extended review. So while there's a lot more work that goes into an extended review, and with that a higher cost, it still is much cheaper than receiving an audit. Now, once you get an extended review, you don't necessarily have to have one every year. That depends on the results of what we find in that review. It may be that you only need to receive an extended review every so many years. Again, it depends on the results of that review. And that is the difference between a basic review, an extended review, and what triggers an extended review.